Hello, everyone, and welcome to the second quarter 2023 edition of Charting Forward. This is our market outlook series where we bring together three experts in the markets in technical analysis, coming together as a group, having a conversation, an open discussion. We often talked about some of the great conversations that happen when cameras are off after we do interviews on Stock Charts TV. This is an attempt to recreate that magic for you. And what's really cool about it now is we're doing it live in our studio in Redmond, Washington. So we're going to have a conversation about the overall market conditions. We're just wrapping up Fed week. We have seasonality to talk about. We have gold at all-time highs, oil breaking down, major averages in this choppy sideways period, but a lot of stocks underneath the hood that are moving. So how do we make sense of all of this? To try to help us navigate these uncharted waters, pun intended, we have three fantastic experts here in our studio. Mish Schneider, who's the chief strategist at Market Gauge, coming to us from Santa Fe, New Mexico. Julius de Kempener from RRG Research, coming to us from the Netherlands, and T.G. Watkins, Director of Stocks at Simpler Trading. Guys, it's awesome to have you in the studio.
Great, thank you.
Yeah, no, thanks so much, guys. And listen, I've talked too often with many of you, with each of you guys on my show through different, different events and everything. But getting a chance to just kind of sit down and make sense of the markets together is kind of a lot of fun. So thanks, guys. So here we're, just to get us started here, we are now sort of exiting Fed week. I guess we're wrapping up Fed week. No real surprise at 25 basis point hike. And now I feel like now that is in the rearview mirror, the big question is what's next, right? And how do we make sense of things? Mish, to start with you, we're at the S&P, the NASDAQ, sort of testing resistance, but not quite able to break through. When you look forward to the next month, 2 months, 3 months, what do you see? Do you have a target for the S&P, and how has that evolved here?
Well, I started out the year thinking that we were going to have a range of 3,200 to 4,200. So we've certainly seen the top of that range. So now it begs the question, are we going to see the bottom of that range? And I think it really is going to depend here what happens with some of the more U.S.-centric areas of the market, for one being the Russell 2000, which is hovering on a very important support level right now, which would be a 6 to 8 year business cycle low that it broke briefly in COVID, but came right back through it. And so it's actually been holding it, as have all the indices, for well over a decade. So we're at a possible sea change at that point if it breaks down and cannot get back through it, in which case I would say that 3,200 target for the S&P becomes more likely. But I also think that if we do get anywhere down there, it would probably be a really great buy opportunity for so many different areas that have been beat up in the market.
The S&P definitely going to 3,200. That's what I heard you say. But I get what you're saying about that range and what they're. TJ, to pivot to you, do you see that sort of range-bound period? What's the likelihood that we retest the lows that we've experienced?
The thing that I've been looking at is that the S&P is up near its high resistance, but then the IWM is at its low support. And that is a very large divergence between where two indices are. And the thing that I've been watching is for the IWM, it's been going sideways for literally a year, to May of last year. And it's done fairly well over the last year, actually oscillating through its daily 50 SMA. But this time, if you guys look at the charts for the last week or two, it has actually been bear flagging into a downtrending daily 50. And I think that if that persists, this is going to be the point at which we actually can pinpoint that if it's going to go lower, this is where it's going to do it. And I think that the fact that the SPY was up at its upper resistance, and if it can't go higher, then with the IWM going down, it's going to also signal that maybe the rest of the indexes are going to cycle down too.
Julius, to bring you in, right, there's that dispersion, I guess, that differentiation between the S&P, the large caps, the small cap. When I think of rotation, of course, I think of you and your work with the RRG. What do you make of that sort of, I guess, disagreement between large caps and small caps at this point?
The dispersion between large cap and small cap stuff usually can tell you something about the risk on, risk off side of things. Generally, I think we all know that small caps are doing really well in bull markets because then everybody's gung-ho about what's going on. Large caps are a little bit less. And when, push comes to shove, everybody tends to flock towards the large caps and they are kind of a safe haven, I guess. So that's about the rotation. But you asked about, year-end targets for the S&P.
Sure.
And you asked me that question last night. So I actually pulled an all-nighter to come up with that. to come up with an...
Okay, this is a great build-up, Julius. Okay, we're all hanging on this. What is it?
So there's a story here. So first of all, it's a terrible question. We know about that.
Okay.
Year-end ask a technical analyst for a year-end target of the S&P is a terrible question, but we all ask it. So the first answer to that question is like, I don't have a year-end target. Yeah. And then I think you had some sort of a sub question like, did it change from the start of the year? Well, the answer to that, well, if you don't have a year-end target, it didn't change from the end of the year. However, I thought, you know what, I'm going to give an answer. He wants an answer, I'm going to give an answer. So what I did is I just did a show on seasonality, which I do every month for Sector Spotlight. And I thought, how can I come up with a educated guess for whatever target there is? So I went on stock charts. I pulled up the seasonality chart of the S&P 500 over the last 20 years. Yep. And there is the odds or the numbers. How often did the S&P close higher than it opened in that month? That's right. And it gives you a percentage. Like for May, I know on top of my head is 75%. Yeah. You're going to go 1 year back because we're already including 2023. So I end it at 2022, and then I use those numbers for the entire year. Okay. At the bottom of that bar is the average percentage gain for that month. Right? So when you multiply the percentage of the months that are higher than it closed, and you multiply that by the average gain, you got some sort of a, like, I don't know, educated guess of what the return for that month will be. Right. At the start of May, the S&P was at 4170. Yep. If I do the cumulative returns, as I just told you, 4353. That's your year-end target for the S&P 500. Interesting. Based on the seasonal patterns. Seasonal patterns with the average return, that's it. My best educational guess I can get.
So you do have a year-end target.
I do. Right? I mean, I do now.
Let's be clear, right? See, there you go. You're welcome for that inspiration. So what you brought up seasonality. I mean, Mish, when you're thinking about sell in May, go away, that's obviously this is the time of year when we talk about it. We've had such a run. April not as strong as maybe it could have been, but another a decent start to the year for a lot of stocks. Is sell in May, go away the way to play 2023? Do you think?
I've never really been a big fan of trading off of platitudes. Yes. Right. So that's not a thing right now. Clearly, we've started out May week, so those people look really right. But there's an interesting other seasonality that you and I talked about yesterday, and that is really what's happening in the world of bonds.
Right.
And so after the Fed meeting, right, I think one could assume, and I know the percentages are already starting to tick out there of what's the pause percentage for the next meeting, and they're saying it's rising, that there'll be a pause. From a seasonality standpoint, May is often the highest point for the yields. Yeah. And when you're looking at things like 10-year notes, we know that those have obviously gone up with the inverted yield curve. But if you're looking at some of the other more interesting bonds to me right now, and you're looking at high corporate bonds, and you're looking at high yield, high debt bonds, junk companies, they are also not only very much in a range, but they are so undervalued compared to their forward yield analysis. 7% for high corporate bonds and close to 12% in the junk bonds kind of tells you that if they can stabilize here and we start to see yields soften and Fed policy cooperates, I mean, it wouldn't be crazy to think that you have so much cash on the sideline, sentiment so incredibly bearish, that at some point we could see a rally, and that's why I would not dismiss anything. But right now, like I said, besides the bonds, which are giving me the most hope, I'm really very keen on what's happening with the small caps, as you mentioned. And they don't have the type of capitalization that an Apple has or an Amazon has, that they can buy back billions of dollars of their stocks to keep their stock shareholders happy. They are actually reflecting what's happening in the U.S. economy, which clearly we've seen contract. So it's a question of, can yields soften, and how much more are we going to contract? Or are we going to do the true nature of stagflation, where we don't contract anymore, inflation still manages to go up, and we just sort of stay more persistently somewhere in a range?
I want to come back to the Fed in a minute if we could, because obviously it's a big theme. TJ, I'd love to bring you in on seasonality. Is that part of your thought process? How big of a concern or an impact in your decision making would be the seasonal tendencies. We're now in the weakest half of the year.
Yeah, there are a lot of seasonalities for individual stocks, and as far as the market goes, sell in May, go away. In my experience, the platitude does work for the beginning of May, but a lot of times it can be a buy the dip situation. So we're in an area where the market is really just so range bound that I am definitely willing to be playing the sell in May, go away, plus the fact that the Fed was at the same time. So there were a lot of things that were just angling this thing down, plus the SPY couldn't get past its upper resistance. So, trading it to the short side for now. And we'll just have to see how far it's going to go down and if it's going to bounce. But, I think that we're still trying to draw out this bear market. I know the market is just raring for whenever the Fed pauses or pivots. But history tells us that whenever that happens, that's kind of when the recession starts, or that's when problems happen, because the Fed is going to keep cranking this up until things start to break. I mean, we've seen this with the banks, so I think they're waiting for more to break. And we just need to keep waiting for all this to happen in order to actually reach some sort of bottom. The Fed will eventually come in, start trying to fix things, start adding stimulus, and that'll be when the bear market's over. So we just have to keep waiting for that and let it work itself out.
The rate hikes we've sort of gone through, it seems most likely that we're now done with, have certainly they've ravaged the financial sector, but arguably the rest of the market's all sort of feeling these ripple effects. We don't know. Julius, when you're thinking of, I think of you out of the group here, probably the most pure technician, I guess, is maybe a way I would think of it. I don't know if that's fair or not, but I'm very curious, given the fact that we're in this condition where the Fed is having sort of this unprecedented, for many of us, period of rate hikes, how does that impact your assessment of rotation and of sort of the larger trends going forward?
Well, it certainly impacts it.
Yeah.
Because the market responds to it.
Yes.
And that's what I look at. So I don't necessarily have an opinion on what the Fed is doing or how it comes out. I'd like to see how the market responds. And, I'm still kind of an outsider in this whole U.S., Fed thing. So I look at it and then everybody knows that the Fed is going to hike 25 basis points. But then there's the press conference. So everybody knows, and then the press conference comes and then something completely different comes out of that. So so that
you do understand it. Then.
I do understand it, but the problem is that I think, what's the use of going through that, because you absolutely have no idea what they're going to say, and that's essentially what the market is responding to. So I kind of let that go and just see, all right, here, this is what the market, how the market thinks about that whole setup.
Yeah.
And not necessarily worry too much or spend time on figuring out whether they're going to take 25 basis points or 50 basis points.
Well, as you know, they're looking for clues. They're looking for any words that's going to ease or this or that, and they're trying to interpret, since don't fight the Fed. So the market's just trying to figure out, where's the Fed trying to guide us?
Can we anticipate it as much as possible?
Well, and also you have to realize that the Fed, it was pretty obvious what was going to happen in 2022, that they were going to have to raise. They have been so reactive, not proactive. And I think if you just think a few steps ahead logically, rather than obsess, like you say, on the actual verbiage that comes out of every meeting is the most important meeting ever, then you realize that if they're going to be reactive, they absolutely, after 40 years of accommodative policies, had to raise the rates to control the inflation. And at the same time, now that they've done their damage with the rate of how fast they've actually done this, it's just, the reaction is going to have to be, not even what they say, it's going to have to be, they've proven it over and over, in a reactive state to try to save things, including their own face. They're going to have to pause, and if things deteriorate further and we go more into a recessionary stance, then they may have to start cutting back a little bit again. So, who cares what they say? It's obvious.
Yeah, well, that reminds me of a conversation I had with a journalist last week when you and I were in New York.
Yeah.
And they were talking about, Fed and rate hikes, and I was like, I don't really have an opinion on that. But so during the interview, it came up like, all right, so what do we go for? We all know that, Fed has been lowering rates forever, and that kind of was on the back burner to push the market higher. Now they raised it very rapidly. And the way I look at it is because they raised it so rapidly, there is now, because the Fed didn't have any room to lower any further, right? So
Zero is pretty much it.
So the fact that it's now back up created new opportunity to lower. So if the market wants to take that as a positive, then I'll take it.
There you go. There's room, right?
Yeah.
Yep. Well, so you had mentioned earlier, Julius, when you were talking about just the volatility that tends to happen during the press conference, which is absolutely right? Things tend to be quiet. Then after, Powell's making comments. What's interesting about the volatility situation right now in the markets, pretty low, right? And we're sort of back down into that range that we were in 2021. 2022, pretty noisy year for volatility. What do you guys make of the fact that the VIX is now below 20 and appearing to kind of stay there for a while? Is that a good or a bad thing, or is it more just descriptive of where we're at in the cycle? What do you guys think?
I think it's kind of descriptive of where we're at. I mean, if you look at the NASDAQ and the S&P, it has been drifting upward. And so as
drifting,
it's been,
right? Not plunging,
it has,
drifting,
so that's the thing. So volatility's kind of gone away. Average true range has calmed down. We've been seeing some of these things to where there are certain things that have calmed down. The market itself has kind of calmed down as it's drifted upward. Now, underneath the hood, underneath the surface, we know that participation is very narrow. The FANG stocks are the ones leading, big stocks like that. And kind of through my view, I think what's happened is so many other stocks out there have basically just kind of reached an area of equilibrium, and they've been hibernating for so long. A lot of things have stopped going down. They're just kind of doing this. They're like, okay, we're dead. We're going to go in hibernation, and we're just going to be waiting for the rest of the bear market to work its way up. We're going to wait for the Fed to come in to save the day, turn this whole policy thing around, and then we'll get into a bull market. And it's just in this waiting period.
The bear's in hibernation. I like that.
Yeah.
That's actually very. That's
well,
a great.
With that, we might actually with the VIX. I like to watch the UVXY and the UVIX as far as a trading vehicle, and I am seeing some indications that there might be something building. So if we are up here at where the S&P is, and if it starts to roll over again, this could be kind of the next leg, the next surprise. Maybe it could be the last one, kind of like what you were saying is, hey, if we get the next big rollover, this might be closer to where things start to break and we start going into recession, because we're starting to see those kind of numbers from the economy. And the sooner we can get into recession, the sooner the yield curve uninverts, the sooner we can kind of get through all this, cleanse it all out, and then kind of start the process over again. So I'm kind of watching the VIX and saying, we might be at a low area, VIX low, look out below, to where we might actually start getting a bit of a spike.
Do you agree with that, Mish, in terms of the volatility?
I think that's actually a really astute observation. The volatility is reflecting almost uncertainty more than fear or confidence. Yeah. And so that's why it's stuck. Too. And in all the great moves that washed everything out that we've seen over the last 30, 40 years, volatility spiked. So it would actually be painful for people who are sitting long in passive income type of things, but it would certainly be a great washout if we saw the spike in volatility at the same time we saw just another flush. And how many things are there out there right now that could actually cause that? So far, the banking hasn't really caused it, right?
Yeah.
So it kind of makes you wonder which one of these incredible tornadoes that we have around us. Is it going to be geopolitics? Is it going to be China? Is it going to be Russia decides to throw a nuke, or North Korea? Is it going to be Mother Nature because we're entering El Nino, which is horrible for crop growing and food shortages? Is it going to be in this country? Are we going to have more social unrest? I mean, clearly we've had a series of violence like spectacular in this country. What does that say? And then, take it from further. Are we going to have a debt ceiling? Are we, there's everywhere you look, and yet the volatility just sits. So it's almost like, are we going to get a pass? Kind of like
a soft landing.
You listed all these potential catalysts, but what's amazing to me is the market's doing what it has in the last 6 months with everything you just said being totally true, right? We've gone through bank failures, and if you told me ahead of time, we're going to have a couple of pretty key bank failures in the first 4 months of the year, I think the market's probably a disaster at the moment.
I mean, that's what a lot of people have been saying. I think a lot of people out there are very surprised by what this market has done.
Yeah.
Everything that's happened, everything that's gotten thrown out, and it's actually been drifting up. It's like, how is this happening? Yeah. Now, maybe there's one argument about our kind of, not modern monetary theory, but more like our modern stock market, the fact that so much money is concentrated in 7 different stocks. Yeah. And Julius, you were talking earlier about flight to safety. I mean, so much money goes to these stocks that they are the market, and everything else around it can die and wither as long as these hold up. So now the question, I think, kind of becomes like, how long can these things actually continue holding up? And at some point, will they get hit and come down or cycle back down? Not that they're going to implode or anything, but cycle back down a bit.
Yeah.
And I think that's kind of what we're looking at.
It's so funny because we were talking before we started the show about how there's a small number, but there are some stocks that are, like communications, like some media names, I'm thinking, right, that have just been just horrible charts. And, the emerging tech, kind of ARK innovation funds, weed stocks, right, these are things that are just kind of going down. But the average thing's kind of down and sort of tripping around a little bit. But the benchmarks are actually doing pretty well. And we have, I'm looking at Apple here, sort of at the upper end of the range for the last 12 months. Julius, when you're thinking of some of those mega cap names like Apple and Microsoft, to your point, TG, they've become sort of defensive plays. Yep. Is that the signal to be looking for here as a warning? Is that Apple just isn't shiny anymore? That's a horrible way to say it, but you know what I mean.
Probably. Yeah. And to the what we were just discussing about all that stuff that's going on in the market, didn't really respond. I actually wrote an article about that in my blog a couple of weeks ago. And the title was when a market is not marked down on bad news. So the market can absorb all that bad news without tanking. That tells you something. That's a message under the hood. Yeah. When I look at the current sector rotation, we have a situation where money is now rotating out of offensive stuff and moving into defense, but still the market's not going down, not really going down. So there is sector rotation going on, and that those defensive stocks apparently are strong enough to kind of hold up the market. And I started using 3 groups, so offensive, defensive, and then sensitive. That's based on a study by State Street who did that, and they brought up that like sensitive group. And if you look at the group of sensitives, then you can see that that's split because technology and communication services are in sensitive, and industrials and I forgot the 4th one, are in sensitive. Yeah, and you can see that technology and communication services are way upright on the RRG in the leading quadrant, so they're really driving the market right now. Yeah. And that in this whole discussion makes total sense. So offense and defense are kind of opposite, and sensitive is kind of driving the market. So that is totally fits with that narrative where we're actually not going anywhere. Market absorbs any bad news without too many problems, and we're just waiting for a new catalyst to actually push to the upside, because it looks like the market is ready to do that, or we're completely wrong and we're sort of, market is still digesting all that and all of a sudden comes to realize that this whole world is going to shambles and it goes the other way. But I don't see that right now, actually.
Yeah. It's like John Wick. The market's like John Wick. I've watched all 4 episodes.
Who's John Wick?
So every bad guy with a gun misses him, and so he's able to dodge like
exactly.
Like the Matrix.
Yeah. Especially 4. I just saw 4 recently, and there's this spectacular scene. I mean, the number of bullets go flying, and he just keeps getting up. Of course, it is Keanu
like the
Reeves.
Unstoppable action.
Yeah. Right.
Superman.
Yeah, but you wonder, what is there going to be some kind of a more fatal type of bullet situation? So you got to. This is not a good time to be complacent. Let's leave it at that.
A couple of you mentioned, we talked about the narrow leadership, right? The Microsoft and Apple, and I think TG mentioned just. I think you alluded to just the construction of the benchmarks, right? If you look at the equal weighted S&P, it's not particularly strong at the moment, right? Not. And what I've heard some people say as well, if you take Apple and Microsoft and Meta out and Alphabet, market's pretty weak. I mean, you can't do that because those are places, equity places. I mean, you can't just ignore the biggest companies, but it's fair that we're rotating into this small, relatively small number of things. How important is it for investors to be looking at equal weighted measures in this sort of environment?
I think it's important to have it in your back pocket and say, okay, it gives you a little bit better sense of what's going on, because I think we can look at the S&P and we're like, wow, this thing is actually doing really well. But then you look around individual names, you're like, where is this all coming from? Yeah. And then you realize, oh, it's only a handful of names. So if you, instead of having to look at 1,000 different stocks, just look at the SPY versus the equal weight, and you see this discrepancy, and you're like, okay, that's Microsoft, that's Apple, that's these stocks. And that helps paint a little bit better of a picture. What can you do with it? I think it's just an understanding that it's getting padded by the larger stocks.
Yeah. Mish, would you agree?
Yes, and actually, as you were talking, I was thinking about our leadership indicator that we have with you guys, because right now it uses a benchmark of the SPY to compare what the leadership is, if it's outperforming or underperforming the SPY. But you can put in almost anything. You could put in Apple or Microsoft or things that are really leading right now, and then see just how under or overperforming it is. And then when it gets to extreme, it could be an interesting play from the long or the short side. So that's absolutely true. And then, of course, there's two other things to really be looking at right now. And we've talked about this a lot, gold. Yeah. And you mentioned it right before we even started the show, the dollar. These are two really other mechanisms that are possibly alerting us to the amazing amount of insulation we've had to all these barbs could actually start to tear away. And gold is telling you this week it went up over close to 2,100, may even get there soon enough. And the dollar is sitting on this incredible support of a 2-year business cycle low. And if it breaks down under like 100.50, that will also have other ramifications.
Talk about gold for a little bit. I mean, gold is one of when you think about what has actually worked in 2023, it's a small number of things, but notable, right? We talked about mega cap, sort of the FANG types of stocks. Semiconductors, of course, have done very well. Some staples names, some healthcare. But gold is probably one of the most impressive runs in our stock chart scooter rankings. It's a lot of gold stocks, which is, I have to tell you, highly unusual. That is not often. My 4 years of closely watching our scooter rankings, it's not often that's happened. Julia says gold is testing all-time highs. Is there something on this chart that would convince you or not convince you that this is a place to still be, even as it's testing all-time highs? How would you approach gold here?
Well, I mean, we all know that the more often a market tests, an overhead resistance level, and the longer that's in place, the more important the break.
Sure.
And that's something that I'm watching right now in gold, because this has a tendency to go higher. If you actually draw a monthly chart and make it a line chart, so not the bars, because you've got a few of these spikes out there in the past. But if you bring that to a monthly closing chart, there's an almost perfect trend line that runs over these highs, and that's been broken. You go more granular, so you go to weekly and daily, you're kind of pushing against those intra-week highs. Yeah. But when gold pops that, I don't know, was it 2,100? When it goes to 2,100, 2,200, I think we're off to the races. And then the whole height of that range is your target. You can project that on the breakout level. So yeah, that's a really good thing. I want to get back to that. Just sorry to interrupt your flow of the conversation, but you were talking about equal weight versus cap-weighted S&P.
Yeah.
There's an interesting thing about there, because everybody's looking at, well, you need to look at the equal weight to ease out the large cap names. Not entirely true, because the equal weight S&P is equal weight at a stock level. So it's got equal weight for the stocks. What is the impact on the sectors?
Yeah, certain sectors are still going to have a pretty decent weight there. Yeah,
especially the ones with a lot of names in it, because then like technology, consumer discretionary, which are two of the biggest sectors.
Yep,
they got a lot of names in them.
Two growthy sectors.
And if you have like 500 stocks that are each at 0.25%, and you stick 70 times 0.25% in a sector, and in discretionary it's probably something the same. That obviously carries a lot more weight on a sector level than when you have 15 utility stocks at 0.25%.
That's right.
So equal weight is not always equal weight.
Sorry, equal weight.
Yeah, exactly.
With air quotes.
It's equal weight on a stock level, but it's definitely not equal weight on a sector level.
And what's funny, you and I, Julius, have spent a lot of time working with institutional investors, and I know from time with the institution, we spent so much so much time. You have rooms of people focused on index construction and
It's crazy.
benchmarks, because if you're trying to outperform the benchmark, it was all about what possible levers can we pull to do that. But I found individual investors, with which most of us work with now, tend to be under aware of that sort of issue, right? Those unintended bets that that people are making, for sure, right?
It's all that stuff that's happening under the hood that, most of the time doesn't matter, or not
until
really.
It does.
Until it does, exactly. Yeah.
Now might be one of those times.
So
right?
back to gold, we're on a roll here. This if you just look at the chart, it's got everything to it to actually move higher this time. So.
Yeah, Julius was mentioning the monthly chart, and for me as a trend trader and swing trader and following these things, trying to navigate the larger trend of what's going on, I like to look at the monthly chart, and I like to use the 10 SMA. And I've been telling people for a few weeks now that you look at what gold did, what some of the gold miners are doing. They've not only crossed over their monthly 10, they've pulled back into the monthly 10, tested it, and have now bounced off of it.
Interesting.
As far as I can tell from a monthly standpoint, that is the beginning of a new trend, and it'll go as long as it's going to go. So I wouldn't bet against it at all.
I always tell people the three questions you should ask when you're using a platform like Stock Charts: identify trends, follow those trends, and then anticipate when those trends are over, right? And look for things. But to your point, like to the chart of gold, it's going up, right?
Yeah, it's not only done that; it's tested the moving average, and then it's making
decent
new highs.
pullback, right?
Yeah.
And now rotating higher.
Yeah. So
do we have a gold bear in the room or no?
Oh, God.
Okay, I didn't think so.
No. I mean, I could be silly and go back to John Wick, and gold is like the enemy that eventually is going to prevail at some point, and that's what it's doing right now. It's reminding us not to get too comfortable. But it's interesting you use a 10 simple moving average on your monthly chart. I've been using a 23-month moving average. And to the point of gold, and a lot of commodities, by the way, they have broken out of their 23 months. So 23 month is basically a 2-year business cycle, right? Where the S&P and the NASDAQ and the Dow flirted with it a little bit more, went right up to that 2-year business cycle, and have failed, right? So those 2-year business cycles, a shorter business cycle within a longer business cycle, and it can often show you the beginnings of some level of expansion. So that's from my mind with the monthly chart. And when it retraced gold, and now a lot of the agriculturals all retraced to the 23-month and have moved back up, obviously gold being the kingpin. To me, right, I hate to say this, but it's so true. I was there in the gold run in the late 1979, 1980, 81. I saw where I was doing point and figure charts and you just go, damn it, just throw it away because it was just going to go off the chart. I've seen that happen, and it feels like that's about to happen again at some point soon. And think why. Back then, it was inflation out of control, Federal Reserve losing policy, dollar going down, and of course, we know what happened after that. But in this case, this is different because the Fed already raised into this.
Yeah.
And do they have the ability or even the desire to do what they may have to do if these things play out? No. So I think we could be kind of in this stubborn trading range that we're talking about, whether it's 4,300 or 3,200 for a couple more years based on all of this.
I've got a question for you. If you want to catch that 2-year cycle, why 23? Why not 24?
Because there's a lag time. And just also statistically, if I had a chart to show you, I would show you how it's amazing that 23 has just given it enough of a slippage and lag time to actually project the 2-year cycle. And like the Dow is a perfect example because DJIA went through it and closed above it in April. And now in May, it's right back below it again. Right. So it's a wiggle room, and that's why we like to look more at the 23 as opposed to a 24-month.
All right.
That's a really good question.
Yeah. It's interesting. Each of you have subtle differences, but there are a lot of similarities in terms of, all of you have mentioned looking at longer-term timeframes. You and I, when we look at the RRG, all of a sudden we're looking at longer rotation. I think there's a great lesson for everyone watching, regardless of what time frame you're trading or investing on, to think about that longer term. I'd love to talk about one more asset class before we finish up here. Cryptocurrencies. Any strong feelings? Because cryptos have started to actually emerge in a position of strength after having a pretty tough year. arguably having a much stronger year to date than equities. Besides Meta, Bitcoin is one of the best places, 70% right so far in the year. Mish, what's your take on cryptos at this point?
Well, three things. Number one is about 15 years ago, my nephew, who by the way worked for Elon Musk, worked at SpaceX, and so he's like one of these little brainiac kids. He's not a kid anymore, but he said to me, the banks are going to be the end, they're going to go away, and it'll all be, all financial transactions will be done either through cryptocurrency and wallets or bartering. This is what he said to me 15 years ago. And it almost feels like we're seeing that now, right? So that's number one. Number two is our algorithmic models that we have, our trading models got us actually into Bitcoin. And so we were in it and then out of it and then in it. And then thirdly, if these two things, if the math and then the call for this incredible long-term megatrend happens, then I would say we have a lot more upside in Bitcoin, and probably some of the other altcoins will just follow as a result.
Yeah. Julius, I would think of you as our resident crypto expert here at Stock Charts. What's your take? I mean, they've had incredible runs from here. Is there further upside in things like Bitcoin and Ether?
Well, first of all, did we just agree that Bitcoin or crypto is actually an asset class?
I think we
solidified
so
that is the first
there we go.
thing.
It's done.
And if that is the case, then crypto is a very interesting space. To what you just said, that your nephew 50 years ago said that all transactions would go through the blockchain and et cetera, and that's happening right now. I'm sorry to burst your bubble, but it's not.
Okay.
If you look at the bigger scale of things, compare the assets in crypto to the bond market or the stock market, it's a drop in a bucket. It means
relatively speaking,
absolutely
right?
nothing. If the entire crypto market would be wiped out tomorrow, nobody would care. There would be no systematic risk whatsoever. So we're not there yet. Is it possible?
Yeah.
Definitely, but we're absolutely not there yet. And the biggest problem with crypto, and that's the big dilemma that crypto is facing as an industry. It started out as being decentralized, and we don't need banks, and we don't need governments, and we don't need regulation, and we're doing it. Turns out that the biggest problem of the crypto world is that it's not regulated, because you got all these scandals left, right, and center, and it will not. There's no pension fund, no institution, no whatever that's going to put serious money into crypto if it's not regulated. I mean, the risks are simply too high. They'll give you all the stories about how secure it is, and then all of a sudden it blows up. So we're not there yet, and that's the dilemma that the crypto industry needs to figure out. It wants to be decentralized and deregulated and whatever, but in order to grow, it actually needs to be regulated, because otherwise the real money will not flow in.
Yeah, you guys are sort of both right? I mean, there's sort of these challenges to wider acceptance, but if and when there is wider acceptance, think of the upside. I mean, think of the potential.
The potential is
there,
gigantic.
But it's untapped.
That's what I was going to ask you, Julius. Are you bullish or bearish?
I'm bullish. Okay. I think that it's actually, if I look at the chart,
right,
and without all the, what's going on around it, Bitcoin is putting in a massive bottom. It's pushing a little bit around that. There's a 30K area. It's not necessarily 30K per se, but there's a big area of resistance. Once that's taken out, I think there's a lot more upside potential. And, so that market, and especially because it's so small, and, small caps, where do you make your moves in a small cap? So you work at Fidelity. You're not making money in Meta and stuff. You're making money in these little things that you pick up at a very low level. It's a 10-bagger or a 20-bagger. That's where you make your money. And that's definitely possible in the crypto space. As a whole, definitely bullish. The chart looks really good. We move higher. We're going to go into a new bull run. Does it make crypto the asset class of the future? Not sure. I mean, a lot of stuff.
Can it do it on its own, or do we need to go into more of an easing policy with the Fed? Because we saw that crypto basically went in lockstep with the financial easing of 2020 and all that. We saw that it was basically acting like a small cap. And again,
which the argument for it was that it wouldn't do that, right? The
Right,
argument was sort of differentiated.
Yeah, everyone thought it was going to
way.
be protected and that was going to be a safe place and it's going to go against. And now maybe it's seen some rejuvenation because of the banking crisis. And I think that people are like, oh, financial issues. Okay, let's go to crypto. And then another thing that I've kind of thought about and heard is like, we in America, we think about our banking institutions. Okay, we got the Fed. Like, things are happening, but we're relatively safe. Think about all the other people around the world that don't have good banking systems and can't trust the government and can't do these things. And crypto might actually be one of the saviors or one of the ways that they could actually store money or store this or store that. And so I just wonder if we're too much thinking about it from an American standpoint of view versus, say, third world countries or developing countries to where, maybe it works for them.
To a degree, but I mean, a store of value, really. I mean, if you just your savings, you stick it in there. Exactly. That's a real question.
And so that's the other thing that everyone keeps arguing about too, is that if crypto is going to either it's an asset class or it's going to be currency, how can you deal with a currency that here's your one crypto dollar just got cut in half?
Exactly.
I mean, how do you?
How do you deal with that?
Yeah.
It's only 19 years old. So I like to think of it because I think of everything in terms of this family that I've created, and crypto is my newest member, and it's the adolescent in the family. So just think about an adolescent. They don't really know what they want to be when they grow up yet. And I think that that's possibly what's happening here, as what you're saying essentially, which is whether or not it becomes more regulated and more of a standard. Definitely, if you look outside of the U.S. focus, there are countries already that have adopted cryptocurrency as their banking system. It hasn't quite figured it out yet, but man, when Bitcoin grows up, it could be explosive.
An interesting metaphor because adolescents tend to think they know everything. So there might be more to that metaphor than you intended. I don't know. So guys, we're almost out of time. This has been so much fun. This is exactly what I would hope we'd be able to get into. We've touched on a lot of things. I would love to finish off just thinking about some actionable ideas and what sort of opportunities you're seeing here going forward. I'd love to go around really quick and just talk about a top performing sector and a bottom performing sector. To think another way, what's the one you think has the best opportunity on the upside? What's the one that's more, weaker opportunity that you would be most comfortable leaning away from? Mish, what would you say in terms of a stronger opportunity? What sector would you be most excited about leaning into?
Well, I would be remiss not to mention, obviously, I'm very focused on commodities, certain commodities, particularly food commodities. The agricultural ETF, which is DBA, has just been rocking. And as long as it stays above 20, it looks like it has a lot of upside. So you have to think about the implications in precious metals. Yeah. But outside of that, and commodities trading right now, I keep telling people it's a good time to learn if you've never traded them before, and you could do it through ETFs. But outside of that, I have been totally fascinated with the live streaming world of global sports, entertainment, and music. And so I've been looking at that whole area. Now, Paramount got killed today, but it would be more of a global. So I'm looking at Formula One, which, by the way, in Vegas right now, they are building a track to go around the entire strip.
That's right, yeah.
The interest and the money coming into that sport is astounding. But also there are other areas to look at as well as possibly emerging. I mean, even something like Live Nation, things that are more global. I think there's great opportunity there.
Okay.
And so think about commodities, what we need, and then what we can do cheaply in an entertainment standpoint as things might get a little tighter on the belt for consumers.
Two interesting angles. Okay, Julius, what would you say?
All right, so you're into Formula One. You know who's the world champion right now, right?
No.
Okay, enlighten us. Enlighten
Oh my God.
Is it a Dutch driver?
Of course it's a Dutch. Let's not go there. So he's worth a lot of money to Formula One. I think he creates a lot of entertainment for everybody. Whether a lot of people like him, a lot of people don't like him, but he's.
Oh, was that the guy they did the Netflix series on?
Well, they do it on everybody.
Oh, okay.
But it's
okay.
like, just look into it, and you'll find out. Sectors.
Yes.
So I just did a show on seasonality and rotation, and what I do there is I like to look at what is strong going into a strong seasonal period, and does that align with what I see on the current sector rotation?
Love it. Yeah.
So at the moment, to me, it's pretty clear technology is going through a pretty strong year, so a strong seasonal part of the year, and it's actually at a strong rotational pattern. So next few months, I do expect, based on those assumptions, that technology will be one of the leading sectors, which it already is, and I think it can carry on doing that.
And what's so interesting about that, it could end up being a very defensive play, right? It's not
exactly.
necessarily offensive.
Well, I mean, it's sensitive right now. So that's why it's out of that group. That's what makes it so interesting.
Yeah.
And then on the downside, it's...
Well, hold on. Let's come back to that. I want to get, TG, your best
Yeah,
idea
as far as for a strength, I mean, precious metals right now, kind of the only thing that I could even remotely say is going to have some strength for maybe any length of time.
Yeah.
Other than that, most sectors have had their flash in the pan, and then they've kind of withered. We've just seen things go all over the place. And so for me as a swing trader, it's been okay because you can kind of catch these things. But as far as a longer term, it's been hard to really kind of pinpoint and nail something down. Yeah. Maybe I've been seeing some healthcare and this and that, but I don't really trade them too much, mostly because they're slower names.
Yeah.
And so, I'm just kind of waiting for actually the small caps to start coming back alive, and I think that'll be the sign of when we kind of start working our way out of all of this.
Having said that, let's stick with you. What's the idea on the downside? What would you be most comfortable not being in right at the moment?
Right. So the downside, I think, has already been down. I call it the ARK ETF funds, the small caps. I mean, the things that all went bubblicious back in 2020. I mean, made a ton of money with that, and we were having a field day. But they all got popped. They all got rewritten, and they were the first to go down. I mean, to the date, it was February 15th, 2021, where all my stops got hit, and that was the beginning of the bear market. And so a lot of them are just, they're going sideways, and they've kind of gotten to a point where they've reached this equilibrium. And, as long as they can kind of keep doing this, and then whenever the market figures itself out, the Fed, the economy, the recession, if we start seeing those come back, if we start seeing breadth actually come back, then that's going to be my sign that we're actually coming back out of this. So the worst performing sector, keep an eye on that for when we're coming out.
Yeah, what's not been working when it actually starts
watch for
to
when
work.
it does start to work.
There. Julius, you were going to say, what's the best downside idea in your head?
It's a battle between materials and financials.
Okay.
Both are in a very weak seasonal streak.
Yeah.
And they are on a very weak rotational pattern. The reason I'm going with materials is because financials have already taken a big dip. So I think there is more downside potential to materials than to financials. If you're shorting financials right now, you're shorting at a very low level after a slide. That's usually not a very good idea.
Right.
Materials are still at a relatively high level. It just moved into that lagging quadrant.
Yep.
So from that point of view, weak seasonals, weak rotation, I think that materials, if I have to pick one, is going to be the one that is...
What's interesting too, when you think of materials, just going back to the comment on gold, when you think about the materials sector, like the S&P, there's not a lot of gold in there. It's more steel companies and other...
Yes.
It's a non-gold kind of thing. Gold is actually an outlier, looking pretty strong at the moment. Mish, how would you answer that?
Well, sort of a combination of both of what Julius and TG said, is that I do believe that in terms of the downside, when things have gotten so weak, I'm not quite so sure that I would be necessarily shorting the financials, but clearly that's something to stay away from. And I have been looking at the materials, and clearly if the financial has any kind of repercussions in terms of the commercial real estate, like people are saying, then the materials are going to be impacted by that. So I agree with that too. I'm not so sure that ARK has necessarily bottomed here. I think that a lot of the asset classes that she invested in, or the companies she invested in, had zero balance sheet potential to begin with. And she was flying off of some idea that, things would never get bad, and they have. And I think there's a certain number of those companies that can still wind up like a Bed Bath & Beyond, not that they were, but that could just go bankrupt. These are companies that borrowed more money than they actually had. I'm not sure what they were expecting on the other end. We were talking about this last night. And if that is any kind of metaphor for what could happen to some of these other smaller companies that she has banked on, she being Cathie Wood, it's possible that that can go belly up, that whole fund. And maybe that would be the bottom. I don't know.
There's blood in the streets.
I've got a question for you.
Oh boy.
That came actually from the conversation because I didn't know it. I'm wondering whether you guys know it, where the name ARK is coming from.
Ah, yes.
Do you know? I absolutely had no idea.
I don't actually. Do you know the answer to it?
She does.
Oh.
Well, we do because...
We do now.
You have about 20 seconds. Give me the 20-second version.
You go for it.
Well, ARK is a faith-based trading company.
Right.
And so ARK, as in the Bible story of
No kidding.
Noah's Ark.
Didn't know that.
I had no idea.
There we go. This is an educational discussion as well.
I wanted to put that as that's a bonus of today. That's
Guys, this was an absolute pleasure. I really appreciate each of you individually, and it's been great to get to know each of you in your process. But getting the group of this together, we've never met as a group, actually, and had this kind of discussion, and I'm thrilled with how it went. So Mish Schneider, Julius DeKempener, T.G. Watkins, thank you guys each so much, and we'll have to do it again sometime.
Yeah, sounds great.
Love to.
Folks, that's a wrap for Charting Forward, an open-ended discussion. We hit on a number of different topics, thinking about narrow leadership, thinking about this sort of choppy, sloppy phase that we're in, but that there are opportunities out there and how important it is to focus on the charts, to recognize strength, to identify weakness, and to manage your risk effectively. We hope you're able to use some of these discussion points. Use the Stock Charts platform. Check out the contributions of each of today's guests because they all have plugins, they have tools that are featured on the Stock Charts platform. I would strongly suggest that you check them out because I think they very well represent the best practices of technical analysis. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe.